by first taking a look at, setting the scene for automation. What does it mean using automation and AI for underwriting? Maybe I start from you, Tyler. If you give us a sense of, broadly speaking, how you look at automation for underwriting, and more specifically, what do you guys do that help lenders automate the underwriting workflow?
Well, I see automation as really limiting human touches, but not removing the human out of the loop. Because we're all human, we all forget stuff. If you're doing manual process through Excel or email, our platform really allows you to automate and govern those processes and allow you to be able to still have the human in the loop, but limit human touches.
And then, Matt, on your side, I hear from you from time to time that you talk about automation at scale, but also control at scale using automation. You got a bit of sense of what you mean, and then also specifics of what you guys do to help to leverage AI for automation.
Yeah, so automation, often you come to a sense that there's a black box that's going to replace all the underwriters, and that's just not the case, right? Automation at scale is giving underwriters leverage. It's how do you grow 2x, 5x, 10x, and do it with consistency, doing it with accuracy, and doing it with increasing amounts of data. Boy, there's so much to talk about in this. We could go on forever. It's doing it with speed in a way that is traceable and auditable, and so that your risk officer is happy, your CFO is happy, your investors are happy, and your regulators are happy. Then again, doing it at speed and scale, right? And there's a you want to do this with more and more data, and doing it in a cascade of data, so that you're doing it with identity and fraud and credit and alternative data and banking data and cash flow data and deal-related data. And if, for example, then if you're, when I say deal-related data, if you're an auto, you're taking into consideration the car or the down payment and a variety of other things. And you have to take all of this stuff into consideration, and you're doing it consistently. I don't know. There's so much to talk about here, but yeah.
You said it all, I think.
No, you have your CFO, CRO happy. You're a really good person.
You have to do this though, because humans, we make mistakes, and you have to do this so it's explainable, so that it's auditable, and it's replicable at scale. And automation is the only way to do that consistently, so that you can lay it out in an audit trail. But you apply humans to the exceptions. Humans are still critical. There's still judgment to be applied. There are edge cases where judgment has to come into play. But only apply the humans where those edge cases are really warranted, right? Don't get the humans in the road. Don't get the humans in the way all the time. If you do this properly, we've had lenders take processes that go 48, 72 hours down to 2 minutes. When you do this, speed captures more business, so you're driving top line. Automation strips out OpEx, so you improve bottom line. And automation improves accuracy, so variance within the portfolio decreases, so overall portfolio performance improves. I mean, this is what automation can do. But automation is easy to say. It's difficult to do, but don't let that concept get in the way. You'll say, oh, my organization isn't ready, or I have trouble in my tech stack, or there's components in my industry, the things external that won't let me do this. Don't let all that noise get in the way. There's ways to start. There are plenty of people in this room that are doing this. Everybody up here is here to help you do this. Please start somewhere. There's tons of room to have this discussion and plenty of people to help you start, because this is where it's going, and if you don't start, you will lose.
And I really think that's the key. You got to start. Just like with your AI journey, you've got to start. If you never start, you're never going to get ahead. So you've got to start. Whether it's your AI journey, whether it's your automation journey, you've got to start it.
So Matt, like just following up on that, so when we talk about in the automation journey, let's say there's a lender that want to look at it from an earlier stage. What's the right stage of looking at it? Is it looking at the journey and map the process? Is it the rule engine? Like, where would you suggest to start? Like, Tyler.
I would suggest to start with the rules engine, because that's really the foundation of underwriting is the rules engine. So I always recommend starting the rules engine and then you build on top of it.
And we started a little bit about the process, but also looking at terms of if you want to a little bit move further, and Matt, you quoted some metrics as well, the ROI, and then how to turn automation into business value. Maik, either can you give us an example or some metric in terms of how lenders need to look into the business value out of automation, the ROI out of automation? And if you have a practical example, that would be super insightful as well.
Yeah, great question. I mean, like, hi, everybody. I think like different things that you can increase with automation. I think one of our customers in Canada, they're called Float. It's a B2B credit card company. Number one business value there was just increase kind of like the document intake, decrease the human labor that you would need to do there. Pretty easy, like it has nothing to do with like credit defaults in the first place. You just want to like have speed to the market, and instead of like having a 4-week answer rate in order to get someone like a credit card application, they want like in a day. So that's number one, it's very easy. And like the faster you get to customers, the more likely you're also going to win them. Second one is also what you both mentioned, very important, like having better data at place. And a lot of, for me, AI in automation is not just making better decisions with AI, it's just having better data available. If you then, by the end of the day, you use a rules engine, that's incredible. But first of all, you need more data available, which then, by the end of the day, allows you to make more segmented risk decisions. So the second one is, of course, lower credit defaults. But yeah, those are the two ones I would look at in the first place.
And that was like a good further deep dive into the ROI, because everything is about business value, right? We're not doing automation for the sake of automation. We're doing automation to drive greater business value. I don't know, Matt, do you want to add in terms of the ROI? Because that's such an important topic in terms of how lenders think about measuring the ROI in various contexts of underwriting automation. Or any examples, either you or you go ahead.
I mean, I touched on it already too, and it's there are so many ways to do that, but it comes down to the different components of data and how you apply them. But it starts with the rules, right? So it's combining the data and the rules and how you apply that. Are you looking at customer acquisition? Are you looking at underwriting? Or what part of the process are you trying to tackle? Don't just automate for the sake of automating. That's a quagmire. Don't try and eat the whole elephant all at once. Like that's too much, and that will bog you down. Find your pain points, find the friction points, and just start with a piece. You might also say, oh, this is the biggest, most valuable piece. It also might be the most complex. I wouldn't necessarily start there. Find your quick wins. Find some of those quick wins to build some momentum. So I don't have the perfect silver bullet of where you should start. That's going to be your own unique journey and your unique answer. But find the small, valuable friction points in your organization, in your process, to build some momentum and build some quick wins. And that's going to be
Tyler?
Well, like Maik said earlier, it's about customer acquisition. The faster you get a customer decision, we live in the world of everything's on our phone. We want to have everything done now. So within this process of having automation, it's going to make your ROI go a lot higher because you'll be able to get decisions quicker, whether it's funding a loan or declining somebody. So that will help you out there. I think that's where the ROI really is.
So let's move a little bit to adoption hurdles, right? In terms of the challenges in adopting automation as well. Like personally, like we've worked with lenders for automation. A lot of time, legacy system is a challenge, right? From time to time, depending on the automation into core banking or otherwise. Even sometimes automation engines built years ago has become, kind of a challenge. A lot of time is organizational culture. At times, people in the organization don't see this as empowerment enabling. They're worried that they may lose their jobs, and then find ways to create challenge for implementation. So thinking a little bit about the adoption challenges, Tyler, I wonder if you have any perspective of adoption challenges and how to navigate through that.
Well, we see a lot of customers, want to navigate these challenges from a process excellence center. So we see a lot of our customers want to build process escalation centers today. So they see that really where they get the adoption is they create a funnel of all these different business units within their organizations, whether it's underwriting, whether it's marketing, whether it's other business units want to create, what about this, what about this? And they create a center of excellence, which then says, okay, I can solve this problem, I can solve this problem, and then they really start to see momentum happen and get more and more adoption as people bring ideas to the center of excellence.
Yeah, for me, I think in everything consumer underwriting, it's much easier. It's much quicker. I think B2B, like you have all these processes in place where you need to replace. How do you communicate with the customer? What type of data you can get? So how fast? So for us, consumer, it's really about the data and the AI in many cases. And in B2B, it's almost a transformation project that comes with it. But it's been solved by now, and I think many of the banks and lenders out there heavily overestimate the burden of replacing a system. But I'm also speaking in terms of my interest here.
Yeah, at Trust Science, we're probably more like Taktile here in that we are a bureau, and we have data, we have proprietary data, we have scores, we also have a decision engine, and you can take any or all of those a la carte. So we just try and plug and play of whatever our consumers' needs are, and so if a decision engine is helpful there, we have that tool set. But it's getting into the heart of an underwriter's process, and that's sort of like open heart surgery to them, so they're a little delicate about that. But hey, if you need a heart transplant to live, that's sometimes you got to do that.
Yeah, and maybe one thing to add on here, I think another challenge especially comes from the regulatory side. But I think it's not automation is in my eyes not about just putting AI into everything. It's slowly moving from rules to a more statistical model to kind of an AI type of world. And by the time you've been doing that for a couple of months, you have so many proof points that you can kind of definitely say, why did I decline a customer? Why did I accept a customer? Why did I accept a customer was actually by the end of the day maybe defaulted or not? So I think I wouldn't just try to own the whole world from the first day on, but just slowly moving over from rules to AI.
Let's go a little bit deeper into that topic, and actually maybe it's a good segue to move into AI and the personalization. If you think AI obviously can personalize risk at a scale. What does excite you about it? What does it about it that scare you away? What's the regulatory impact on that, right? What's the business impact on that? If you think AI as a way to really personalize things, especially risk, in a way that we've never seen before.
Yeah, what I think is very exciting that we can in lending go away from judging in risk buckets to judging on risk on very individual and personalized levels. I think that's very, very exciting. I think what's on the other hand kind of scary is the opacity of decisions. But this argument has been in industry probably for 5 years, 6 years now, and it's becoming more and more of a solved problem. Everyone talks about only black box model. Not all models are only black box anymore. You can do a lot of things if you do them right. Also maybe breaking down AI in terms of what happened after ChatGPT was released, the whole large language model LLMs versus a lot of AI, which is more around the machine learning side on structured data from kind of the years 2016 to 2020. I'm a data scientist, machine learning engineer myself. That's why we founded the company. I wanted to revolutionize credit with AI. It's much harder than you would think. But so for me, just differentiate between LLMs, which are harder to interpret, but no one uses LLMs to make a final credit decision. What people are using LLMs for is getting, and that's incredibly powerful for our topic of automation, getting unstructured to structured data. Incredible. But once you've done that, no one cares about if you read out bank statements or accounting data or anything with LLMs. That's not regulatory an issue. You're just getting unstructured, structured data. Awesome. No one cares about that. But having that data, you can just put it into a beautiful rule system, and you've already increased kind of a decisions by a ton. Or you start to use more simple machine learning models, which is also a way to make more precise decisions.
And I think you said the right point. It's using the right AI in the right position.
That's right.
So like LLM's great at data. Big data, they can be able to process data, but you still need to be able to say, okay, here's what I sent to the LLM, here's what I got from the LLM. And then you might move it to a machine learning model or generative AI to make more things. That's really where it comes into using the right AI in the right position. You don't want to use the LLM for everything. You don't want to use Gen AI for everything. You want to use it for the right things.
So let's pull on this thread some more, and hopefully we've got some distinctions between Gen AI and LLMs versus machine learning, and we could spend a whole afternoon on this. But how do you then get to that personalization, and you can take a vast amount of data from an applicant or through an application and use all of these tools to make much more precise decisions. You can say yes more often safely, as I will often say, better data, better decisions. But then with a decision engine, how do you adapt that? Right? And so we've helped lenders be very dynamic in this, and you want to be very dynamic. This is where a decision engine in the right hands, you can make a lot of adjustments very quickly. And when I mean quickly, this is not like on a quarterly review or something. This is on a weekly basis, doing tests, running data, running scores, running strategies either silently or running 3, 5, 10% of your volume. Oh, is that still on? Running 3, 5, 10% of your volume through a new strategy. Running 3, 5, 10% of your volume through a new strategy. And is it me? Is that still? Oh, there we go. and iterating and testing and adapting those strategies and testing new data, but also modifying it. So, for example, you may you may tighten in a geography or jurisdiction. You may adapt your underwriting for a certain channel. If you're in automotive, for example, you may tighten on a particular dealer, right? Why wouldn't you don't, this is where a decision engine allows you to tailor, not just with data, but you can tailor your strategies for circumstances and for channels and a whole variety of things. If this dealer or this group of dealers is behaving badly or giving you poor quality, tighten. And you can tighten on a dealer. There's a whole variety of ways you can adapt your underwriting and test and control. And that's where control at scale, but also being flexible in your strategies, how you test and how you apply at scale. But it also requires good data and good BI and really, really good feedback loops. So you get the data back, you know what's going on, you can drill in and apply that control in a very measured, flexible way. So good data in, good BI, good decision engine to give you all of that kind of control.
And I think you touched on a point. It's about control. We're in a highly regulatory industry here with lending. And the government's going to catch up with AI. The government's going to come down and say, okay, here's the rules around AI for lending. It's going to happen. So they're going to catch up here soon. So companies got to be ready for that. They got to have AI, which is traceable. Governance is going to be extremely key in all these processes. So that's really what platforms like ours allow you, is the governance to be able to say, okay, this is exactly what was the LLM, this is exactly what happened in Gen A, and be able to track that and trace and audit that for the government when it does come, because it is going to come.
So we talked a little bit about control and then data here. To go a little bit further, a lot of lenders are worried about losing control. They rely too much on external parties and losing data. And the flip side, they usually are struggling with having the right data coming to them, available to them in the processes. So what is the experience in terms of working with lenders, in terms of, their legitimate concern about losing versus keeping control and giving their data or keeping the data for competitive advantage? And a lot of time not even having the right data. Have you faced that? Any suggestions around that? And from there, we go to the build and buy decision, obviously.
Yeah, I think what's interesting, data and lending is also changing right now a bit with, again, LLMs. People consider LLMs to only, make decisions, but there's a lot of knowledge from the internet built into those LLMs. Pretty much everything that anyone of us has ever seen is in those LLMs. So what I find interesting about data is you don't only have to buy everything at a third-party data vendor. Like a lot of things around onboarding or around KYB, you can actually get via Perplexity, for example. I think that's one thing which people not utilizing enough for the moment. And then the second one is, again, think about everything that you've ever seen that you did not have digitized, you can digitize it now. And we used to need very specialized, very expensive OCR companies. Like, I don't want to be an OCR company right now. I'm not, but I'm very happy that I'm not, because you can get pretty much everything into your decision engine, into your rules engine, into your underwriter's hands by using that technology. So you have creating data in your own hands by now, which is also a change in mind shift a little bit.
And to dig a little deeper on that, it's about orchestrating the data also. You got to get the data from the LLM or other systems, but then you got to orchestrate it between all your different systems. So whether it's your core banking system, your lending system, your CRM system, then you got to take that data that you find from the LLM and these sources and then put it in those systems and correct so that you can, manage funding the loan, getting past the loan, getting a payment, maybe doing collection. So you got to make sure all that data flows through there, and using the tool that be able to do that so you don't lose any data is also key.
And if you want to move one step further to build versus buy decision, most lenders do not want to build everything in-house. That's very extraordinary, like it's very unusual. Yet they struggle in terms of what to build, what to buy, how to combine them, what's the criteria, what's your perspective, Mark, in terms of the build versus buy decision? What criteria do you typically look into in terms of is the build, is the buy? What are the right component to build versus buy, or buy versus build, essentially, or what has been experienced? I mean, we understand that every lender will make their own decisions, but to what extent you can either generalize it or give a specific example for the audience. That's one of the huge decisions, the build versus buy across the lending value chain.
I love that discussion, that question, because like when we started the company 5 years ago, and one of the reasons that we started the company was because I was building credit and risk models for banks and lenders, so I had to work with the legacy in-house systems, or like kind of more like legacy decision engines out there, and I thought like this cannot be real. Like we have AI changing the world, we have a Cambrian explosion of data, and like the world is being more and more automated. Like there must be something else. So, however, because of that, like I wasn't the only person in the world thinking that. Otherwise, people would have bought the decisions out there and wouldn't have built them. So it's like it's a huge discussion for me every time when I come to a big customer, especially the larger ones. They all have built something in house, and my take on that is by now, in 2025. Doesn't make any sense to build your own kind of like decisioning platform anymore. And why is that? Because there are like incredible companies out there like Decisions.com, like Taktile, that have invested so much into that IP that you can just get it off the shelf. And if I'm thinking about it, like I'm being a lender, like why would I build? Because I might have a competitive advantage. But that competitive advantage was true in 2016, 17, 18, 19, because all the other things out there were crap. So you had a competitive advantage if you built a very cool and specialized system. But now, having there's at least 5 out there, they're doing an incredible job in terms of decision engines, and they're all better than whatever anyone has actually built in-house. So that's my general philosophical kind of like answer on the whole point. I think if I'm a lender, to be more specific around what I should own, look, what I would not, like, you should own your credit models. You should own your data, because that is your competitive advantage. If you understand how to segment risk better than your competition, then you actually have a competitive advantage. But the shells, like the tools and shovels, you can just get.
I agree, because you do want to be a software company or a lending company. That really comes down. We're software companies. That's what we expertise in. We have dev shops. We have people that do this every day. Do you guys want to manage your dev shop and then what to worry about in 3 years the maintenance cliff, or let us manage that for you? That's really the key question.
And if you take a step back and look at the lending value chain, or even the underwriting, there's just so much there. Decision engine is part of it, but it's not the only thing, right? In the whole flow, the value chain, or at least the underwriting part of the value chain, right? What are the components that you would enable a lender, and what are the components that they need to build capabilities, either themselves or partners? Do you see a gap between the decision engine platform that, let's say,
for me, the model building is something you really should do yourself. Mm-hmm. Like, what are the weight? Because like I cannot tell any lender what's their risk profile. Like, do you want to have more customers? Do you want to be more profitable? I just don't know what your utility function is. So like, it's very hard to like get that off the shelf. That's what you need to think about on your own on a day-to-day basis, because it does change. Interest rates go up, you have to change it. Interest rates go down. So that's definitely one thing. Own the risk.
So, and we have 15 seconds to go.
I mean, maybe if this thing's on. That's where some may not be able to do that, or they need some help, or they need some help to complement that. So if you need help, it's out there, I guess. So yes, you want to build. I agree 100%. The lenders have to own the risk strategy 100%. That's got to be your core competency. You should be able to build your models. If you can't, though, or if you struggle with that, there's complementary stuff out there, and there's obviously additional data. What we'll say, I often do this motion, that orthogonal data to bring you additional perspective to complement or bring you additional perspective. You know, there's more tools out there. So I guess look outside, and that's also where decision engines and alternative data help.
And Matt's comment would be the last insight for the audience to conclude this panel. Thank you so much, everyone, for your insightful comments, and thank you so much, everyone in the audience, for participating.